Hey, good morning and welcome to this Tuesday, July 25th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. It's certainly a pleasure to see you this morning. I'm going to walk you through the market, taking a look at some of the things I think are important as we prepare for the market open today. Had a great session last night on Q2 earnings. For members out there with Earnings Beats, if you weren't able to attend, I think you might want to check that out. We also had an Excel spreadsheet that is available for download for any of our annual members that lists close to 200 stocks that we'll be reporting later this week. I separated them by stocks that I think will have strong results versus those which I'd be a little bit less sure about going in. We've been tracking these over the last couple quarters and have found that the relative strength, and that's primarily what I use when I evaluate upcoming earnings, relative strength has really turned out to be a great indicator of the results that we get, not necessarily the market reaction. Many times you can have a great earnings report, but because companies have already gone up heading into those earnings reports, it's more of a buy on the rumor, sell on the news type of a situation. So I think that would be a great start, though, if you're looking at earnings season, to go through and just check out the way I've broken down those stocks. So make sure you do that. Tell you what, let's go ahead and get started. There's a lot going on. We do have the model ETF portfolio draft tonight. And I can tell you, let me get the numbers out here. So what we do is we put together a portfolio of ETFs. And the whole idea is to try to outperform the S&P 500, because if you can't outperform the S&P 500, then you should just get the S&P 500. But if you can put together a portfolio of ETFs that can outperform over time, I think you can do it'll make a big difference, obviously, in your financial future. I can tell you this. We just closed out our latest model ETF portfolio, and we run these kind of on a strange quarterly basis. We go from January 19th to April 19th, then from April 19th to July 19th, July 19th to October 19th, and then October 19th to January 19th. And the whole idea here is it's right before earnings. We're kind of projecting what we think the market's going to do. And then we put together a portfolio based on those themes. And again, the idea is to try to outperform the S&P 500. Last quarter, April 19th to July 19th, our model ETF portfolio gained 13.91%. And the S&P gained 9.19%. So we outperformed by well over 4%, almost 5 percentage points in one quarter. That was the fifth quarter out of the last 6 that we've outperformed the S&P 500. So I feel pretty good about what we do at Earnings Beats, especially when it comes to ETFs. So that's going to be later today. We're actually doing our draft. Now, normally we do it July 19th, but historically, the 19th to the 25th of the month, not too great. So we decided to exit our portfolio from April 19th on July 19th, just as we always do. But rather than draft on July 19th, we decided to wait a week, get past what can be a seasonally difficult period. And we decided we would draft tonight the ETFs that are going to go in that portfolio. And that's what we're going to do. So definitely check that out. So if you go over to Earnings Beats, the best, if you're interested in coming in, we have a very unique way, by the way, of putting these ETF portfolios together, our model ETF portfolio. We use our ETF analyzer spreadsheet on Excel. We've got a number of ETFs listed there, and we've got the breakdowns as to how much is represented in each ETF by every sector. And once you put in the allocations of what percentage you want in what ETFs, whichever ETFs you decide, the ETF analyzer will actually calculate your total portfolio and tell you how much do you have in technology, how much do you have in consumer discretionary. And so, what we talk about with, investing in ETFs is know what you own. So many times you hear, oh, this ETF's been hot. Let me just throw some money in there. Let me throw some money over here. And at the end of the day, you really don't know what you own. You don't know whether you're overweighted in certain areas. And it's really helpful at the end of a quarter if you fall short and you come up short of your expectations or the benchmark S&P 500. It's easy to go back and take a look and say, okay, well, I underperformed because I had too much invested in the industrials and the industrials underperformed. So it's a little easier to go back and actually grade yourself and hopefully improve your process as you go throughout time. So anyway, I wanted to just share that with you because if you go over to earningsbeats.com, you can start your no-cost trial, 30-day free no-cost trial, and you can come in to this event tonight. And I'll tell you, if you invest in ETFs, it'll be a mind blower for you, the way we take a look at this. But let's keep moving. Let's take a look at the action and what happened on Monday to start this week. First of all, I think it was a great week, or excuse me, a great day, a great way to start the week. Number one, Mondays historically are the worst calendar week or worst calendar day of the week. The Monday after options expiration is typically the worst day of the calendar month. Not typically, historically, it is the worst day of the calendar month. Yesterday, Monday, was the day after July options expired, and we saw an up day across all of our major indices, which, again, I think given the circumstance, given where we were, negative divergences, I think it was great to have a day like that. Now, will it stick? I don't know. We're going to talk about that a little bit. Yesterday, we saw a lot of strength from value areas. We do still have those negative divergences. I looked at my sustainability ratios. They're not exactly supporting this move that we've seen the last couple of days back to the upside. So there's definitely things that we need to talk about. But let's go over the numbers first. Dow Jones Industrial Average finished up 0.5%. The S&P 500 finished up 0.4%. The NASDAQ, home of a little bit more of those growth-oriented stocks, especially the mega cap growth, they were only up 0.14%, so trailing both the Dow and the S&P. Mid caps up about 0.1%, small caps up 0.6%, and that was your leader yesterday. Small caps actually led all of our major indices. Transports down a little bit. So after breaking back out just a few days ago toward middle end of last week, we're seeing transports pull back a little bit. And again, that's fine. We've got a great looking chart. We've had a huge move to the upside. It's okay to give a little bit back. But looking at the sectors, I think, again, you can see the strength in the value-oriented areas. Energy leading the pack, up 1.6%. Financials up almost 1%. Real estate up almost 1%. These three areas, certainly not those aggressive growth stocks. Oil, equipment, and services, that was the big part of energy. And this is the hottest group within energy. Right now, this area right up here around 320, we're challenging highs that we saw earlier this year. Breakout here, and I'm starting to get a little bit more bullish with what I'm seeing on energy. You can see the breakout, the uptrend, the bounce off the 20-day moving average, PPO pointing higher. You can go down here at the bottom, the AD line now moving to about a 2.5-month high. A lot of things looking better on this energy chart. So this could be an area that maybe outperforms a little bit as we go forward. Banks. Want to know why financials did well yesterday? Well, here you go. The Dow Jones U.S. Bank Index up 1.78%. This was your leading industry group within the financial sector. Continues to move to the upside. I find this to be extremely bullish for the market, because if there's one area that tends to struggle with an inverted yield curve, it's the banks. You can throw banks, life insurance companies, investment services. Those are the areas within the financials that tend to really struggle with an inverted yield curve. The fact that the banks have broken out of this period of consolidation and are now trending higher above the 20, which is above the 50. PPO is strong. Look at the AD line moving to a multi-month high. All of these things suggest to me that the stock market, which typically looks ahead 6 to 9 months, likes what it sees on the horizon for banks. And what that means to me is that the market sees this inverted yield flipping again, back to the upside instead of being upside down. And that should help the banks. And I believe that's why we're seeing this run now in the banks, anticipating a change in our economic conditions going forward. Autos also had a really strong day, up more than 3% yesterday. We had gone down below the 20-day moving average for the first time since all the way back in probably the middle of May. And we were able to jump back up, cleared the 20-day by just 2 points. We'll see if we can hold it. I'm not so sure. One thing to look at is look at that rising price action and look at that falling PPO. This is an area of growth. We're seeing that rotation out of growth a little bit and into the value. If that continues, I think autos, this move up to the upside could be short-lived. Not saying we're going lower. And I get a lot of folks out there who will write in maybe on YouTube or whatever and say, well, you know, pick a side. You talk about the market going higher, but then you say you're cautious and it might go lower. Well, here's the deal. I'm bullish. That's it. I'm bullish. But there are periods when risk rises. So it's not the same. You don't approach the market with the same aggressiveness. If I'm bullish and I've got signals saying full speed ahead, not only am I in the market, but I'm going to be looking at those leveraged ETFs, trying to juice my returns when the market is in a good phase and moving higher. What I am saying when I talk, I don't know if the market's going to go down. I wish I did. All I can say is my signals are pointing to a higher market. And in the short term, you run into these periods where you start getting a little long in the tooth. You start seeing momentum issues develop, which we saw on the 60-minute, the hour chart. That one's already resolved. That little bit of selling that we saw has already taken care of the negative divergence on the 60-minute chart. But we also have these negative divergences on the daily chart. They can play out over 1 to 3 weeks. Do they have to play out? No. And we're in a secular bull market advance, in my opinion. So it makes it a little bit more difficult. And as you invest in the market during these periods, you need to have risk on your mind. You need to be thinking, hey, we're in a bull market advance, but there are issues out there that makes it a little bit more risky. Do I want to be in leverage? If the market pulls back because of a negative divergence and you're in a 3 times leveraged ETF, it's not going to feel good. I can promise you that. So, but would I short? That's an individual call. You have to decide, you know, what you're going to do. I don't like to make those calls for others. I'm not a registered investment advisor. All I can tell you is that there's more risk and the odds of a pullback are much greater than, say, a couple of weeks ago. You know, sentiment in the short term turned very, very bullish. Long term, no problem at all. Big picture, the Freightliner indicator that I like to use on the equity only put call ratio, no problem. But when you're talking about these short term 5-day moving average, that's what I call my speedboat indicator. It can, you know, give us short term signals and then turn on a dime. That short term speedboat indicator tells me, or told me here over the last few days to a week, that we could run into some weakness. And I've been talking about it. I've been writing about it. But the potential for short-term weakness is different than my belief that the market's going a lot higher. And if you don't understand the connection, I don't know what else I can say. The only thing I can say is when I start getting cautious signs, I trade differently. I'm still bullish, but I trade differently because I feel like the risk is elevated. Now, for some, it might mean going to cash. If that's what it means to you, go to cash. If it means shorting, if you're really aggressive trader, you think the market could go down and you want to be on that side of the trade. And hey, if you're wrong, you're wrong. By all means, do what you think, what you're comfortable with. For many who are simply looking at the long term and could care less about what's going on, or couldn't care less about what's going on in the short term, stick on the long side. That would be what I would do, because I think the market's going higher. Even if we have a short-term blip, I think we come out of it and we set new highs, either this quarter or next quarter, and continue pushing to all-time highs down the road. I think that's going to happen in the fourth quarter. So anyway, hopefully that explains it a little bit better. I mean, I don't know really how else to explain it. I'm never going to be in the mindset where I believe the stock market's going up every single day. There are times when I wake up, I think there's a 75% chance we go higher. Other days I wake up, I might think it's 25% chance. I'm kind of in that 25%, 35% category right now with these negative divergences. I'm just not trusting that we're going to go higher in the short term. Again, whatever that means to you. 10-year Treasury yield. So let's get an update here. Right now, we're at 3.91. We're starting to trend higher again. Today starts the FOMC meeting. Tomorrow, we're going to get probably another 25 basis point rate hike. That's what the Fed has been prepping us for. And so that's what I would expect. I don't think they're going to tell us they're going to raise 25 and keep telling us that they might raise another time and then pull the rug out and not raise. I don't think that's going to happen. So they've been telegraphing it. They're telling us they're going to go higher. The thing I find interesting, we know the Fed funds rate will go higher. That's tied to that. That's basically what they're raising, is the Fed funds rate. And that's the rate that banks can borrow. That's kind of their borrowing rate in the short term. The 10-year Treasury yield that we look at, this is a 10-year. This is looking out. This is a long-term part of the yield curve. And this is going to be impacted a little bit differently because it is long-term. Short-term, it doesn't really get impacted by inflation. Because the rates, you get a 1-month Treasury. Well, are you worried a whole lot about inflation for 1 month? Probably not. If you're buying into a 10-year Treasury yield and you believe that inflation is going to go higher, or you have higher expectations for inflation, you're going to want higher yields on the 10-year Treasury yield. And the way you get higher yields is simply more sellers than buyers. As you see selling in 10-year Treasury, if the bond market is worried about inflation, you'll see the selling in bonds, which will send the yields higher. And that will give you the higher return to offset the higher inflation. Because if you're sitting there with a 3-year, 10-year Treasury yield, or 3% 10-year Treasury yield, and inflation 6%, I mean, what are you doing? You're losing 3% a year purchasing power. So what I find interesting is that while the Fed keeps raising the short-term rate, notice the 10-year Treasury yield peaked back in October of last year. We haven't gone up any further. The bond market is saying, we're not worried about inflation. We'll happily own a 10-year Treasury yield at 3.90%. If you believed inflation was going to stay at 5 or 6%, that would not be the case. You would see yields soaring like we saw back in the 1970s. And I know a lot of folks look back and say, well, the yields have been soaring. This is the fastest move up, blah, blah, blah. Well, again, let's talk about perspective. Where were we 3 years ago, 4 years ago on the 10-year Treasury yield? The reason we went up so fast is because we went down so fast during the pandemic. I mean, we went down from 2% to 0 or almost 0 in no time. So yeah, I mean, when we came back up, a lot of it, in my opinion, was just normalization. Others look at it like, oh my gosh, this is the fastest rate hike. But again, if you're looking at the last 2 years, then yeah, I can see where you're coming up with that. But you look at the long-term picture, and literally the yields went boom, boom. So I don't really see as big a problem as maybe some others see. I look at it and I try to look at the intermarket relationships, and I try to figure out the story. And to me, the story is that inflation's not a problem. The rotation, I see now money rotating finally into banks. We've seen the value stocks starting to play a little catch up, which is nice after a huge run in growth. growth stocks are coming down. And it's so crazy because when the value stocks and dividend payers and so forth weren't performing well, everybody talked about poor breadth. Well, the market's going to struggle because of poor breadth. And then when we see rotation out of growth into value and the breadth picks up, Dow does well and the Russell 2000 does well. Now everyone's saying, well, you know, some of these growth stocks aren't doing well. And that's what led the market. This could be a sign. It's like, just give me a break. I mean, seriously, you're just looking for a reason. Look at the charts, everyone. Just look at the charts. We're going up from left to right. That's pretty much what until that changes, I wouldn't really worry. And if we go sideways for a little bit in growth, I have no problems. Even if we pull back, my gosh, we had such a run. If we pull back, the key is, does the S&P 500, does the Dow, do the major indices take a tumble? Do we see selling in everything? Or are we just seeing some rotation back into the groups that weren't performing well? Look at the Dow Jones. Dow Jones finally breaking out. Let me pull up this chart. Let's go out a little ways. I mean, we went down the cyclical bear market. We made this rally back up late in the fourth quarter of last year. And then while the NASDAQ was just taking off all year, the Dow could not make a breakout above its late November high until just recently. Now we're trending higher in the Dow. That's awesome. IWM, there was the November high. There's your downtrend throughout 2022. Here's a reaction high in early February. We're moving now, but I tell you what, if we take out this February high and we take out this August high on the IWM, which is around 198, we're just about there, we're 195, you're probably going to see a continuing melt up in small caps. I love it. Wide participation. We want everything participating. Energy's coming back. Great. I don't see a problem. Now, short term, yes, I see a problem. I see a little bit of a problem, especially in those growth names. How long it lasts, we'll see. Long term, I think it's full speed ahead. All right, chart of the day. So if you're interested in the chart of the day, I always like to bring up our website because if you scroll down, you can subscribe to our Earnings Beats Digest. It's not a chart of the day, but it's 3 times a week, which is still pretty good. 2 paragraphs in a chart. It's a very quick read, usually focusing on things that are important to us. So obviously technical analysis, price volume, breakouts, breakdowns, tests of moving averages, relative strength, earnings gaps. Those are the types of things that we're going to focus on a lot. Sentiment, sometimes big picture charts about the market. All of that you'll find if you sign up. So name and email address, all it takes. It's completely free. No credit card required. You can unsubscribe at any time. I think you'll like it. I think you'll find it educational and hopefully improve your trading skills. But make sure you scroll down over at earningsbeats.com and sign up there. Here, if you go in and check our historical performance, individual stocks, especially recently, got hit a little bit with some of these growth stocks heading into option expiration. But look at our ETF portfolio. Now, this quarter is a little bit misleading because we're still running this quarter past July 19th. But because right now our model ETF is portfolio is in cash, but it will be full of ETFs tomorrow because at the end of the day today, we're going to have our draft and pick our ETFs. We'll talk about what percentage of each ETF will make up in the portfolio. And we'll talk about themes. We'll talk about why we're going into these ETFs. And I think that's really just as important as the ETFs themselves. You got to have conviction on what you believe the market's going to do. There may be groups that are just starting to make breakouts that we want to overweight a little bit. Those are some of the things that go into the selection. So anyway, we'll be doing that tonight. And again, if you're over at our home, you've got a 30-day free trial just by clicking on that green button. We'd love to have you. So what's the chart of the day today? Well, This is the chart. This is what I was talking about a little bit. Here's the S&P 500, and below are my sustainability ratios. The NASDAQ 100 versus the S&P, QQQ versus a spider. And that's, the QQQ is just more heavily weighted with a lot more growth stocks. The S&P has growth stocks, but it's a little bit more toward value. So it's more of a split. Then we got the XLY versus the XLP, consumer discretionary versus consumer staples. And so that just gives us a little bit of an idea of within the consumer space. Remember, GDP is comprised of 2/3 consumer spending. So within the consumer space, is that money rotating toward XLY, which is more aggressive, or XLP, more defensive? IWF, IWD, that's the Russell 2000 growth versus value. And then we have the Dow Jones US growth, large cap growth index versus large cap value, mid cap growth versus mid cap value, small cap growth versus small cap value, and transports versus utilities. So these are the things that I like to follow in terms of what's going on underneath the surface. So when the S&P is going up, is the money rotating more towards aggressive growth? If so, the market's in a risk-on mood. And when that's the case, we tend to think, or at least I tend to think, bullish thoughts. When it's going up and we're seeing these ratios decline, that can be a problem. And that's one of the reasons, there were others, but that's one of the reasons why I called a market top back at the end of 2021, because the S&P kept going up. Meanwhile, Wall Street was rotating out of growth and into value and into defense or defensive stocks. So when it's going up, are these ratios going up? And you can see that this is the last 10 days, intraday chart. So these are 15-minute candles, and it goes back 10 days. And if you look, when we were in that rally on the S&P, pretty much all the ratios that I like to follow were going up with it. We saw these two, mid-cap growth and small cap growth, start to roll over just a little bit early, but everything else was going up. And then we rolled over and the S&P started going down and all of these started going down. Okay, everything's fine up to this point. Well, look what's happened the last 2 days. The S&P's gapped up both days, tried to push a little higher, and I'm looking at the QQQ versus spider, that's continued to go down. XLY, XLP's gone down just a little. IWF, IWD, growth versus value's gone down. Large cap growth versus large cap value down. Mid cap growth versus mid cap value down. Small cap growth had a little push up, went down to a new low yesterday versus small cap value. And transports versus utilities going down. So all of my key ratios the last 2 days have gone down while this has gone up. Now, some might look at it and say, well, there you go, market's topped. Well, I wouldn't. I think 2 days worth of action maybe is probably not quite enough. And there's also a lot of other indicators that I look at that are screaming bullish to me at this point. So I'm not going to read too much into this, and especially when it's option expiration week or right after it. Because which stocks are going to get hit because of max pain? Growth stocks, because most growth stocks have a lot of option activity. Value stocks don't move very fast. Option traders are not going to be interested in value stocks. Procter & Gamble, go check out their options. They're not exciting. But check out Apple, or check out Tesla, or NVIDIA, or AMD. These mega cap growth stocks are the ones that can get hit around option expiration. And if they do, then these relative ratios are going to suffer. So a lot of this could be nothing more than max pain and, opposite George week. So don't read too much into it. I like to share these indicators that I like to use, but you've got to be able to step back and use a little bit of perspective, common sense. You got to put all the different indicators together. It's a big puzzle. And a lot of folks who are perma bearish, when something's not working, they point to that and they say, see, yep, it's got to go lower. And then that starts to work. And then they find something else. Well, this is why it's not going to go up now. And then that turns around. Think back, breadth. How many folks were saying the market was weak because of breadth? How many are saying that today? Nobody, because now the value stocks are playing catch up. Anyway, don't want to spend any more time on that, but this is a concern. So this is a pretty important chart of the day. It is 9:30. I just wanted to show you on our strong earnings chart list. And if you're a member, you get this, you can view it. If you're a Stock Charts member as well as an Earnings Beats member, you can actually download this right into your account, as long as you're at least extra or a pro member. But here's our strong earnings chart list as of July 14th. I've got some updating to do because we've got a lot of earnings reports coming up. I'll try to get to that this weekend. But every day you can go in and see what's working. You also can see which sectors and which industry groups are at the top among these strong earnings companies. The other thing you can do, look at if I sort it by scooter. So here I've got everything sorted by scooter. Now, many of these are those aggressive, you can see technology. So some have been hit a little bit because of, I think, Max Payne options expiration and so forth. But you still see at the top of the scooter chain a little bit better action than what you see at the bottom. Here are the lowest scooter scores. And look at this, almost everything is down. Again, if you go to the top, while you do have some down, you got still some pretty decent winners in here as well. So anyway, multiple ways to use these chart lists. I'm going to take a quick look at the market. Let's see how we open. We had futures up. Now we've got the Dow down 27, S&P down 1, NASDAQ showing a little bit of relative strength. That has not been the case. We'll see if that holds up. That'll be important, I think, in the short term to whether or not we can go up from here to the end of the day. Now, NASDAQ gapped up and is showing strength at the open, but showing strength at the open is a lot different than showing strength at the close. Let's see what happens to the NASDAQ throughout the day. Is it a big day for the NASDAQ in terms of absolute and relative performance, or is it simply just a gap up and then we see more money rotate into the Dow and the S&P? That'll be one thing that I watch really closely today. The VIX still hanging in below 14, up just slightly today. Small caps, mid caps, both down a little bit. So we got bifurcated action right now for sure. That's it for me. Please join later today. We're having that model ETF draft. I'm telling you, if you like ETFs or you invest in ETFs from time to time, I think you will love the presentation later today, and you can come as a trial member. So check out that 30-day free trial. Everybody have a great day, and let's get ready for the Fed tomorrow. We'll get an announcement tomorrow afternoon. Could be crazy. Happy trading, everybody.